All right, episode 90 of Charged Alpha. And today we're talking about one of the most iconic names in all of tech, a company that literally put the silicon in Silicon Valley, Intel.
And the timing here is fascinating because Intel right now is not the same story it was even 12 months ago. The stock has more than tripled off its 52-week low. It just joined Elon Musk's Terafab AI chip project, and there's a genuine question for the first time in years. Is the turnaround actually working?
That's exactly what we're digging into today. The numbers, the narrative, the risks, all of it. Let's get into it. So Intel was founded back in 1968 by Robert Noyce and Gordon Moore. Yes, that Gordon Moore, the guy behind Moore's Law. Headquartered in Santa Clara, California, and for decades this was the undisputed king of semiconductors.
And what makes Intel unique in the chip world is that it's an integrated device manufacturer, meaning it designs and fabricates its own chips in-house. Most competitors either design chips and outsource manufacturing to TSMC, or they just do foundry work. Intel tries to do both, and that's the central tension of the whole investment thesis right now.
The company runs 5 main segments. Client Computing Group, which is basically PCs and laptops that pulled in $8.2 billion in Q4 alone. Data Center and AI, which is the Xeon business, plus FPGAs, did $4.7 billion last quarter, up 9% year over year. Then you've got Network and Edge for telecom infrastructure, Mobileye for autonomous driving, and the big one everyone's watching, Intel Foundry Services.
IFS is the wild card. It became a wholly owned subsidiary, and the 18A process node entered high-volume manufacturing in October 2025. That's the node that's supposed to put Intel back on equal footing with TSMC. And here's what makes this moment so critical. NVIDIA just invested $5 billion in Intel Foundry Services. The U.S. government converted CHIPS Act grants into a 9.9% equity stake. These are not small bets.
And just this week, Intel joined Musk's Terafab project. So the question isn't whether people believe in the vision. Clearly they do. The question is whether Intel can execute. Now let's talk leadership, because this is actually one of the more unusual situations in corporate America right now. Intel doesn't have a permanent CEO. Pat Gelsinger, who was the architect of the whole foundry turnaround strategy, departed in December 2024. Since then, the company has been led by interim co-CEOs, David Zinsner, who's the CFO, and Michelle Johnston-Holthaus, who runs Intel Products.
Zinsner brings deep semiconductor finance experience from his time at Micron. He's respected for financial discipline. Holthaus is known for operational execution and strong customer relationships. Together, they've kept the ship steady, but the market is waiting for a permanent leader who can own the foundry vision going forward. The search is being run by Spencer Stuart, and there's no public timeline.
It's a real wild card for investors, because you're putting billions behind a strategy, and the person who conceived it is gone, and nobody knows who's going to take the wheel permanently.
Let's get into the financials. Intel shares closed at $58.95, giving the company a market cap of about $294 billion. Now, on a trailing basis, the PE ratio is negative 646, which tells you Intel is not currently profitable on a GAAP basis. The forward PE is around 103, which is elevated, but reflects turnaround expectations.
And the price-to-sales ratio?
4.1 times, which is actually below the semiconductor industry average of about 5.8 times. So on a revenue basis, you could argue there's a discount here relative to peers. Price to book is 1.85.
What about the top line? Revenue has been essentially flat, right?
Flat to slightly down. Full year 2025 revenue came in at $52.9 billion, which was down about 0.5% year over year. If we look at the quarterly trajectory, Q1 2025 was $12.7 billion, Q2 was $12.9, Q3 ticked up to $13.7, and Q4 came in at $13.674 billion, which beat guidance.
So there's a slight upward trend through 2025 at least.
There is, but Q1 2026 guidance tells a different story. They're calling for $11.7 to $12.7 billion, which would be a sequential step down. Management cited internal supply constraints and a seasonal dip in client computing. Now, on margins. Gross margin was 36.15% in Q4, which is improving but still below historical levels. Operating margin is negative 7.51%, and net margin is negative 0.5%.
Negative operating margin on a company this size. That's a big deal.
It is, and it reflects the enormous cost of the foundry build-out. CapEx was $14.6 billion last year, against operating cash flow of $9.7 billion, which means free cash flow was negative $4.9 billion. They're essentially burning cash to build fabs. On the balance sheet, they've got $14.3 billion in cash, against $44.1 billion in total debt. Debt to equity is 0.39, and the current ratio is 2.02, which is healthy from a liquidity standpoint. Oh, and the dividend, suspended since August 2024. No yield.
So bottom line on financial health.
Overall, Intel's financial health is watchful. The balance sheet is adequate, and cash flow from operations is positive, but negative free cash flow, suspended dividends, and GAAP losses signal a company that's investing aggressively in its future at the expense of near-term profitability. The turnaround has to work for the numbers to make sense at this valuation.
All right, let's see what Wall Street's saying. 30 analysts covering Intel, and the consensus is a hold. The breakdown is about 6 buys, 21 holds, and 3 sells.
The average price target sits at $46.97, which is actually about 20% below where the stock trades today at $58.95. That's a notable disconnect. The stock has outrun analyst targets. The range is wide, from $20 on the low end to $70 on the high end.
Who are the bulls?
KeyBank has the highest target at $70, citing 18A potential. Morgan Stanley is at $62, bullish on foundry progress. On the other side, Guru Focus has the stock as significantly overvalued with a fair value estimate of just $26.96.
Last earnings, Q4 2025. Revenue beat, EPS of 15 cents beat the 4-cent estimate by a wide margin. But the Q1 guide was soft.
Right, and next earnings are April 23rd, so just 2 weeks away. That report will be critical because it'll be the first real data point on how 2026 is shaping up.
Time for the bull case. And look, the bull case on Intel right now is probably the most exciting it's been in a decade. Number one, 18A is real. It's in high-volume manufacturing. It uses ribbon-FET transistor architecture and power via backside power delivery. And Intel claims it's recaptured transistor density leadership for the first time in years.
That's the technical piece. What about the business case?
Number two, the customer validation. NVIDIA putting $5 billion into Intel Foundry is not a charity donation. Microsoft, Tesla, Qualcomm are onboarded for packaging services. If Intel can land a major 14A design win, say Apple or Qualcomm for a future chip, that's potentially transformative. Number three, government backing. The CHIPS Act funding, the equity conversion, the Terafab project. There's a national security dimension here that gives Intel a tailwind no competitor has.
Now for the bear case, and I think you have to start with execution risk. Intel has a well-documented history of missing manufacturing timelines. 18A yields are improving, but they're not yet at cost-efficient levels for high-volume external customers. The foundry business has accumulated about $7 billion in operating losses over the last few years.
What about the valuation argument?
That's risk number two. At 103 times forward earnings and negative GAAP profitability, the stock is priced for near-perfect execution. Any stumble, a yield miss, a customer delay, a disappointing earnings print, and you could see a sharp correction. Third, there's the competitive reality. NVIDIA dominates AI accelerators. AMD is growing data center revenue at 30+%. ARM-based designs from Apple and Qualcomm are chipping away at x86 in client computing. Intel is fighting on multiple fronts simultaneously.
Fair points on both sides. This is genuinely one of those stocks where the bull and bear cases are both completely credible. Let's stack Intel up against its peers. We're looking at AMD, NVIDIA, TSMC, and Qualcomm.
Starting with valuations, NVIDIA trades at a PS of 27.5 times, which is stratospheric but arguably justified by 78% revenue growth. AMD is at about 10 times sales with 30% growth. TSMC at 14.5 times with 25% growth and incredible margins, 62% gross, 48% net. Qualcomm is the value play at 4.8 times sales.
And Intel at 4.1 times.
Cheapest of the group on price to sales, but there's a reason. It's the only one with negative earnings. On PE, TSMC at 32 is the most reasonable. NVIDIA at 47 and AMD at 51 are in growth territory. Qualcomm at 16.5 is a bargain hunter's pick. Intel's forward PE of 103 is the highest of the group, which tells you the market is pricing in a massive earnings recovery that hasn't happened yet.
So Intel is simultaneously the cheapest on revenue and the most expensive on forward earnings. That's the turnaround premium in one stat. Options market. What are traders saying with their money?
The put-call ratio is 0.64, which is bullish. That means call buyers outnumber puts almost 2 to 1. Implied volatility is at the 70th percentile of its 52-week range, so elevated but not extreme. Heavy call open interest at the $60, $65, and $70 strikes suggests traders are positioning for more upside. Put protection clusters at 50 and 45 as the downside floor. One important caveat: elevated IV ahead of April 23rd earnings means options are expensive right now, and a lot of this positioning could simply be event-driven rather than directional conviction.
Insider transactions. And there's one that stands out.
CFO David Zinsner, who is also interim co-CEO, bought 5,880 shares at $42.50 back in January. That's about $250,000 of his own money. A CFO buying stock is always noteworthy because they know the numbers better than anyone. That said, the 90-day net shows about $1.7 million in selling, though most of it was routine tax withholding and equity conversions, not discretionary sales.
So the one voluntary transaction was a buy, and it was from the CFO. That's a constructive signal, even if the overall picture is mixed. Main risks to watch. Number 1, foundry execution. Everything hinges on 18A yields improving and external customers committing real volume. Number 2, leadership uncertainty. An interim co-CEO structure during the most critical phase of a generational turnaround is not ideal.
Number 3, margin compression. The foundry ramp is expensive and competitive pricing pressure from AMD and NVIDIA isn't going away. Number 4, valuation risk at 100-plus forward PE. And number 5, the broader geopolitical picture. Intel benefits from onshoring sentiment, but China's semiconductor progress and potential shifts in U.S. trade policy add uncertainty. The key metric to watch going forward is Intel Foundry Services revenue growth. That's the single best indicator of whether the turnaround is translating into real business.
So here's the bottom line on Intel. This is a company in the middle of one of the most ambitious turnarounds in semiconductor history. The technical progress is real. 18A is in production, major customers are investing, and the government is backing it with billions. But the financial picture is still a work in progress. Negative free cash flow, no dividend, GAAP losses, and a stock price that's run ahead of analyst targets and earnings.
The key metric to watch is foundry revenue growth over the next 2 to 3 quarters. If Intel can show accelerating external customer wins and improving foundry margins, the turnaround thesis holds. If the foundry revenue stalls or yields disappoint, the stock is vulnerable at these levels. April 23rd earnings will be the next major test.
We're going to close with a quote from the man who started it all. Well, the latest chapter anyway. Former Intel CEO Pat Gelsinger said, "To me, the only metric that matters is, does it cause the building and filling of Intel fabs? If it causes more fabs to be built and filled in the U.S., then it is good."
And right now, that's exactly what's being tested. The fabs are being built. The question is whether they'll be filled.
Couldn't have said it better. That's going to do it for episode 90 of Charged Alpha, our deep dive into Intel Corporation, ticker INTC. If you got value from this episode, make sure to subscribe and share it with a friend who's following the semiconductor space. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.